So volume spread analysis for me was easier, I think, than most people because I had absolutely no background. I had nothing to compare it to. I had no idea what technical analysis was. I didn't even know what a futures contract was. And so I watched a lot of the webinars in the VSA Club, but it didn't help me because it was already assuming a lot of things. And so one of the things that I think about is you cannot move forward with volume spread analysis, the methodology, unless you truly believe that the market is rigged, that there are smart money maneuvers that are moving in the direction that they want it to go. And you need to accept that in order to, I guess, resist the temptation of hearing good news in the market and seeing it immediately go up. I always think about when you first learn how to drive. My dad used to teach me because I, grew up in Boston, so there's plenty of snow and ice there, and you can't, if you start to skid, you can't brake. You have to steer into the skid, and it's counterintuitive, and I feel like that's what VSA methodology is. It's counterintuitive because why wouldn't the market go up when it's good news? Why wouldn't the market go down when it's bad news? And you have to truly understand that volume equals activity, but volume is the leading indicator, and I think that's what kind of separates us from technical analysis. By understanding volume, you can start to understand a little bit more of the predictive behavior of the smart money. And then, of course, the universal laws of supply and demand. And I think about one of the things that in the beginning when I used to click on all the indicators, read through the bars and understand them, whatever, is, the names of the indicators are all from the point of view of the smart money. So if you think about supply coming in at the start of a distribution, it's their supply that they're unloading, right? You know what I mean? And you think about, well, why is the price rising? The demand must be higher, but in fact it's the opposite. And I think
this is ridiculous.
It is.
We're told to me, saw the price go up, so everyone's buying.
Right.
They must be buying for the price to go up.
Right. So I don't know if those of you heard Gavin from the web, but he's like, this is ridiculous. What do you mean they're selling? The price is going up. People must want it. Think about that toy that, you wanted as a child at the holidays, right? I think about my own, I'm dating myself, but so what? The Cabbage Patch Kid. And my mother waited in line at this store. She had to get a lottery ticket, and she had to wait in line, and she got me my doll. And the demand was so high that you could only buy 2 dolls per person because the demand was so high. So this is completely the opposite. And I think, boiling it down to these sort of 3 premises, if you truly believe that they're out to get you, they are. If you really believe that the volume is truly going to tell you what the predictive nature of the chart is, and 3, if you understand the universal laws of supply and demand, flip it upside down and look at it from their viewpoint, you actually stand a pretty good chance of trading successfully. So we kind of just talked about it, but I always look at it again. I don't have a background in technical analysis. One of the first people that trained me, who's no longer affiliated with TradeGuider, tried to teach me Andrews Pitchfork, pivots, Fibonacci. I couldn't see it, I couldn't see the forest through the trees. It was way too complicated. And for some reason, this actually came to me pretty quickly. But volume truly is the foundation of VSA, and I think that if you understand that when you approach a chart, if you really understand, just look at the volume, what's going on, where is it ultra high, where is it waxing and waning, you stand a really good chance of predicting the charts. And then, you can truly trade any chart, any time frame in any market with VSA, and that's what I love about it. Fundamental analysis is reserved strictly for stocks, and, I think this is a really good overarching principle and methodology for trading.
Tom once said, I asked him the question, how does it work in every single time frame? He said, because if the market's open, it's fractal. It's working. So I'm just looking here at a 1-minute chart of the Aussie, but I can go out to a 15-minute chart of the Aussie, and you're seeing similar things setting up on all the different time frames. So it must work.
It must work.
Supply and demand.
No, exactly, because it's showing up across all time frames, as Gavin is saying, and it really does work. I think that some of the time frames can be better indicators for you. The 1 minute chart kind of freaks me out. I feel like I'm getting eaten by piranhas, so I just don't even look at it. I use the hourly chart because that's, the dictator of the day for day trading. And then I kind of vacillate between the 15 and the 5 minute chart. So here is a May 7, 2010. They called it the flash trade. It happened right here where 16 billion shares were sold in 2 minutes. And I'm just going to play an abbreviated...
By the way, this is the only time I've ever seen an anchor actually saying what she's about to say.
Yeah.
Some of you might have seen this before. This is a shortened version.
This is a shortened version. This is...
Make sure the speakers are on.
Yeah, this is Maria Bartiromo.
8 names that they're going to have to track down on top of the Accenture trade, where we have the stock price intraday showing us at least, we'll assume, a bogus trade of 0.
That is ridiculous. I mean, this really sounds like market manipulation to me. This is outrageous.
It happens a lot, Maria. It really does. I mean, we could probably ask the NASDAQ. They may not want to say exactly how often it happens, but it happens frequently, and they go back and they correct. And the thing that stinks is if you, in good faith, put in a trade and made money and then lost it, you lose it. And there's no recourse and there's no way to appeal.
The market manipulation video, everyone in the room was raising their hand. They had seen it. I'm sure many of you have seen it. It was featured in Gavin's book, a screenshot and a summary of it, but of course it was deliberate, right? And so they apologized and said it was a mistake, and it was an error in typing when they had executed the trade. But we have countless examples of when the news is good, the market goes down, the news is bad, the market goes up, screaming things in the news, and it'd be interesting to see how crude oil is trending today based on all the stuff in the news about Venezuela and, all these long lines. And you start to see trends in the opposite direction, and it's not that difficult to imagine that massive amounts of money that are moving through this world is heavily guarded and maneuvered from the smart money. So volume's the leading indicator to the activity of the smart money. That'll tell you exactly what's going on. Volume equals activity. And ultra-high volume is the beginning of a maneuver. So that's when I can tell that something is starting to happen. And that's what I look for. And so you can see in this chart that you have ultra-high volume. The Trade Gutter software turns things pink when volume is lower than the previous two, which is really important when you get into no demand and no supply. But you can tell, and I'll show you in a moment, one of the things that is always telling for me is, and we mentioned it during Gary's presentation as well, that if I see ultra-high volume and then the market starts to rise and the volume starts to go down, you can absolutely bet the farm that you're in a distribution phase. All right, so some of this may be review, but we really are interested in volume, spread, and close, right? So VSA wants to know how high or how low is the volume, how widespread or narrow spread is the range of the bar, and then where does the bar close? So we have here bar A, ultra high volume, ultra widespread bar closing up near the top, and of course a VSA signal pops up. And those of you in the room, what do you think that signal is?
Bar B?
Nope, bar A.
All right.
I sort of gave it away when I told you that, the prices were rising, but the volume was decreasing at the start of distribution. One of the most popular signals to indicate the start of distribution.
Supply coming in.
Supply coming in, exactly. And then we have bar B, where basically we have another attempt at ultra-high volume to try and push the market up. And the volume starts to decrease and the price is starting to kind of just move in the middle.
Here's a way to think about this that you might find helpful. So we have ultra-high volume on bar A, and the bar runs from its high to its low. The spread or the range is pretty good, right? A lot of movement on that bar. On the bar before B is also ultra-high volume, in fact, a little bit more. And what's the spread of that bar doing? What is that saying to us? It's crimped down, right? It's narrowed down. So this is Tom used to say this to me, and he would say that if that was all buying, then it should be as big as, if not larger than bar A, the spread on bar A. But it's not. So we can see that the volume is basically constant here. They're the same. But the activity, the range in the bar has been stepped on.
So we use volume with supply and demand, right? That's one of the founding principles of VSA methodology. So in normal circumstances, right, you think about the more that the supply is in the market, the lower the price, right? If you flood the market with too much, the price is going to weaken. But in VSA, right, we have to flip it on its head. So as the price is rising, they're hiding their Easter eggs, right? They're putting their supply into the market, and they're dropping it over the course of a bunch of bars. And the only time you really see it is that ultra high volume, ultra widespread bar that kind of the light bulb goes off. And then just when we just showed you before, the last chart, you know, they're basically showing you their cards in supply in bar A. And then what we're looking for with that mushrooming over is, again, if the price is rising but the volume is decreasing, then we know that there's weakness. Eventually, that means there really isn't a demand at a higher price. So you have supply coming in. This is from the standpoint of the smart money. You have supply coming in rising prices. It's the start of the distribution cycle, such as bar A. We also have volume decreasing right after bar A, and again right after bar B and the bar before it. And we're basically looking for that mushrooming over for the demand to fall. But the waning volume is telling you that the demand is going to fall. Now, if you're in the trade and you're going long and you start to see prices rise and you start to see signs of weakness, then you need to make sure that you are watching that mushrooming over, seeing up thrusts. That's an indicator it's probably not going to keep rising. And if you see a no demand and you're in a long hold, you need to tighten up your stops and be prepared for, you know, the market to bottom out. So just to recap the distribution phase, it is the selling of the smart money into rising prices. And it's marked by ultra high volume, widespread bars closing at or near the top. And the number one signal that VSA typically shows you is supply coming in. You might see a selling climax. You might also see absorption volume, but that's a different principle. So essentially what we're looking for in distribution, again, is rising prices and waning volume. It's an inverse relationship, which is why volume is so important, because if you really think about it, how in the world could prices continue to rise if there's no volume, no activity, no effort, no interest to the upside? We've talked about it in a couple of different ways, results versus effort. I call it, that lack of energy or failure to push up. It takes a lot of energy, or in other words, a lot of volume to do that. So these are, indicators that that's happening.
Laura, where would you take the trade in that situation? Would you take it right at the top, or would you take it as it's moving?
In this chart that I'm showing right now?
No, the one behind it, but just in that sort of curvature, which is the mushroom. What point would you say you'd actually start thinking of taking a short? Just out of interest.
So I always look for an up thrust at the top or a failed test at the top. And as it starts to go down, one of the things that I always do is I go back to usually the supply coming in, and I draw a line across the close of the bar, and I wait for it to have, I want a no demand, and I want it to break through that line. and then I short it. And usually you can catch a really nice kind of down, a little bit down, and then when you see the craziness happen at the start of the accumulation, well, you know, you had a nice little run. One of the things I think that's made me successful is I'm not greedy. I'm grateful. So I'm grateful if I can take a little bit up. I'm grateful if I can take a little bit down. Now, the exact scenario that I just described to you, I would also do, I would use that situation as an exit strategy as well. So let's say I was going along and all of a sudden supply's coming in, and then I can see that, again, prices are increasing, volume's decreasing. Okay, I start to see a failed test or an up thrust, I draw that line and I'm going to move my stop up to around that, because if I had already gotten in somewhere before the supply came in, you know, I want to make sure that I'm not going to lose my profit. And so, you know, at the worst, I would put my stop at the no demand, you know, right across the mushroom. But sometimes what I've done, one of my, somewhere between the word accumulation and markup, you should see a test, because accumulation has started, you have that in the background. And as soon as I see supply coming in, sometimes I'll enter the market and just enjoy a nice ride up until I see an up thrust and see what happens. And again, if the volume's starting to really decrease, I'll get out right after the up thrust. So that's been a pretty favorable trade for me over and over and over again. So here we have in the background a period of rising prices. You see some tests in the background. You also see a ultra high volume over the course of 2 bars, and you see an extremely widespread bar. The VSA signal comes in. The next bar closes so far up above the range of that bar, and we basically see we're in an overall uptrend, but we see a little bit of chop right there in the middle. Now, if you were going long, you would basically just start to move your stop up. But if you're waiting to short, you know, it's not ready yet. It's not clear. You're in that situation. And then you look at the top where the second arrow is, right around here, and you can tell, look at the difference in volume. There's absolutely nothing. So in this scenario, I would be waiting for it to fall. And you start to see, you know, when the volume at the start of the U.S. market hits, it's a little bit higher, as it always is in the volume, but no matter how much volume they had in the open, they still don't have the energy to make this market rise. So it's very weak. You know, the medium, the short-term trends are changing colors. There's nothing clear in this picture, so you wait. Unless you're Gavin, then you trade. No, I'm kidding. But you wait, you know, you have to be patient. And so we also have a couple of other principles going on here, right? At the moment where we had low volume and, you know, up thrusts, no demands, we go back to where it was closing, and it's testing. So follow the yellow bar. You have the bar way back at the beginning of the distribution phase, and then it tries again to go up again, and it fails, and then it starts to hit again, and they're trying again and again with all that volume at the beginning of the U.S. market. It's not going anywhere. It goes down for a little bit, and then it goes back up again, and it's not going anywhere. So I would expect this to fall pretty quickly, and this is a 30-minute chart. So obviously I would be looking at smaller time frames to kind of see if it had already mushroomed over. So this is, I really like trading the mini NASDAQ. It's one of my favorites. You all can have the mini S&P, but I'll take my mini NASDAQ.
NASDAQ's moved really nicely.
Yeah, it's fun.
I trade the NASDAQ. It's a good market.
Plus I'm cheap. It's a little cheaper than the mini. So, all right, we have a couple of principles playing out here. Bar A, you have a widespread bar. Now the volume isn't super high, but what you do have in the background is some ultra high volume, and you also have a lot of widespread bars. So there's a lot of activity that's going on. It's just the setup isn't quite clear. Overall, I'm in an uptrend, at least from bars A through C. But what I see is, again, rising prices and waning volume. So I know that there is not a lot of strength in the market to go up. I start to see up thrusts. I start to see no demands in bar C. The next bar closes, and then all of a sudden, you have this really widespread down bar. And if you look all the way back to the first ultra-high volume right here, where the red bar is, go back and look. It's right there. It's testing, 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 testing. Now, you may not get a VSA signal that says dosing, 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 but you will see that it's trying really hard to kind of go back up again. And it springs off and it goes back up again. But look, there's no volume. How can you sustain that if you have no volume, if you have no supply, if you have no effort, energy? It's this is not a tradable scenario for me. It's clear as mud. And Gary, would you feel comfortable trading this? No. Gary said no. What about you, Gavin? It's not clear, right?
No, I wouldn't touch that because it's not clear. I mean, clarity comes through, looking at the chart now, it's clear. It's the British pound, it's been in a downtrend, it's got an accumulation phase, it's starting to push higher.
Yep.
Crude oil is a good one to push well, and Abraham will look at the later, I'm sure, because he likes crude oil, but that's an interesting chart. So because you picked up on that earlier, about crude oil being moving.
Oh yeah, the first thing I did yesterday, I was finishing my slides, and I always go to CNN Money, and I just wanted to know what the big wow splash news was, and there it was, Venezuela. I'm like, oh, I'm sure we're going to see something play out like that in crude oil. So, all right, so here's the mini and 30-minute chart, and this is a really good indication of sort of that mushrooming over. So again, bar A, we have ultra high volume. Now remember, by the time bar A appears, we haven't seen the next higher volume bar, right? Everything's relative to the previous ones. So you have bar A of supply coming in, and then all of a sudden you get all this volume, but like Gary was talking about earlier, look at how narrow spread the bars are. Doesn't that seem suspicious or counterintuitive? How could there not be that much activity, but there's all this volume? What's going on? So then we have narrow, 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 narrow bars, and then all of a sudden we have this, major sign of weakness at bar B, and again, there's no volume.
It's a trap up.
Yep, absolutely.
I call them a gotcha bar because they take out the previous support level there.
So one of the things that I noticed that the E-mini does often at the British Open, right around that time, because I used to come in the morning and I'd be mad that I missed an excellent trade setup, like really mad, is they sometimes do these really clear-cut maneuvers at the beginning. I don't know if they think no one's watching or I don't know, but time and time again, you come in and you can barely trade the U.S. Open of this. It's so choppy. You have no idea what's going on. It's whipsawing you around. And you look back to the wee hours of the morning in the U.S. and you're like, oh, this would have been perfect. I mean, this is truly this gorgeous setup, right? You have supply coming in. You're in an uptrend. The volume's crap. And then all of a sudden, British Open, there's no volume. Why isn't there any volume? British Open. What's going on there, right? So you try and go all the way up and, bar B closes within the range of bar A. So you're starting to see that failure to rise, right? And then literally there's no interest to it. And then all of a sudden, if you look at some of the bars that come after B, like when the signals start to come in, now again, volume is relative. This would probably pop up in VSA's ultra high volume because look at what's around it for many, many bars. Not compared to this, but that's a lot of volume. Falling, 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 falling prices. If you missed any of this, sit around and wait. Look at this. It comes back up. It tests right back in this area, and it falls again. So you could definitely take a short around here and enjoy a little bit of a run. You could be mad as you walk in the morning and realize you missed this entire move, but that doesn't do you any good. The other thing, too, is, Gary, confirm this for me, you'd be waiting, basically, this is a ultra-high volume, widespread bar, closing in the middle. I'd be looking for either a reversal or it's starting to come back up and test right back in this area. Yep. Kind of, yep. So, you have this mushrooming over, but the other thing you have in the accumulation phase is you have a U. You have a U shape, so you're kind of looking again for them to kind of retest back into the closing of the part where the maneuver started. So the maneuver starts with ultra-high volume and widespread bars. So in this case, the accumulation maneuver really started happening here. This is when the volume picked up. And then they try again to make it rise, and they fail. They try one more time back up into this area, and it fails. So if it starts to make this beautiful U, you can absolutely go long once you've seen this. And again, oftentimes when you've seen a test and a test, look for that supply coming in, and you can get a really nice ride all the way up to the upthrust. So the accumulation phase is the buying of the smart money into falling prices, again, which makes no sense, right? It's like catching a falling knife, but they do it. Ultra high volume, widespread bars, closing at or near the bottom oftentimes. And then some of the things that you might see, stopping volume tends to be a very popular one. You know, the buying climax. Sometimes you'll see a 2-bar reversal. You'll see a shakeout. Shakeouts are a little bit more extreme, right, Gav? You know, you don't always see those as the start. But sometimes what I see is I'll see the stopping volume first, often after a no demand or what we just saw, the trap up move. So we've seen the mushroom over, and then this is the start of sort of the accumulation phase. You might see a shakeout or a 2-bar reversal at the bottom of that U. So this is the start. You start to see the ultra high volume. And I'll go back for a second, right? So you start to see it right here, a couple right after this. So all of a sudden you start to see that in a true U. You're looking for that ultra high volume and a shakeout. Instead, you just see kind of failed tests.
Just on the terminology, I just want to correct something because I don't want people to be misled. You said buying climax, that's at the top. Selling climax.
Yeah.
No, I just don't want people getting confused.
Yep, no, you're right, sorry. That's supposed to be selling.
This confused me as well because you think of buying on the down bar, so you have a buying climax, and then you have this selling climax. Well, actually what Tom is telling us, on a buying climax, what's happening is the herd, the uninformed group, are rushing in because they've heard there's a bargain to be had in the market and they think they're going to miss out on this surge in price. So they rush in and buy. Okay, and it's very important. They come in and they say, oh, it's got to keep going up. But this is the ideal opportunity to smart money to start unloading. And something that's really important to keep, David Weiss, who's a friend of Gary's and I, talks about the market changing behaviour. What he means by that is once they start this selling at the top and you get that mushroom coming over and you get the fall of price, that's changed behaviour from bull to bear. It's the total opposite at the bottom. And something else that's really important, if you see massive volume but narrow spreads, because we're talking here about wide spreads, you see narrow spreads, they're actually more important. And Tom uses the analogy in his book. He says if it's at the top, it's called the end of a rising market. Something is putting a lid on the market. And only one thing that can do that, the herd are rushing in to buy, the group, because they've, you know, it could be anything. It's usually news driven. Usually an earnings report or something very bullish. And they come in and buy, and professional money is saying, thanks very much, have it, take it. And that caps, closing in the middle. Total opposite at the bottom, bag holding, which is narrow spread, ultra high volume. But yeah, I just wanted to make sure people understood that.
And actually, the one thing that I should point out that, and now I know why I made this mistake, because it's a mistake. You know when you make the same mistake over and over, I don't seem to... This buying and selling climax as a signal, they're the only signals in the VSA platform that are from the position of the herd. All of the other ones are the position of the smart money. Do you know what I mean? Like supply coming in is what they're doing. These climaxes are the only ones that are actually coming from the viewpoint of the herd. So that's why sometimes I get a little confused. So yeah, Gavin's right. A, it's selling climax because it's buying by the smart money, but it's selling by the herd.
Usually panic selling by the herd.
Very panic selling, right? Because, you know.
Some sort of really, well, BP oil was a classic one.
Right. BP oil, exactly. Can't cap the well, right. I always think of Chicken Little, the sky's falling, so that's what the herd's doing. The other thing, too, is, you know, so again, what Gavin was just describing, because I don't think that one of the hardest things for me when I first learned VSA was trying to put accumulation leading up to distribution and distribution kind of waning as the accumulation starts. And that's why I like this picture, because one of the things, again, is you see those narrow range bars at the very top, and they're selling, you know, smart money selling into the people that are buying because they think they're going long. The market starts to fall. You see a no demand starts to fall. Well, at that point, you know, you can take a really nice short on the markdown, but don't be surprised to see, you know, right here where the arrow is, don't be surprised to see at some point around here, you know, the price goes down, but the volume starts to increase, right? So you have very little volume here. You get a no demand, the prices start to fall through this markdown, and that's where the volume steps in, because that's where they're starting the maneuver all over again. So if you think about ultra-high volume as the start of a maneuver, it can also tell you potentially it's the end of the other one. So that's why it's so important to kind of understand that it's cyclical and it's constant. So now this is the opposite, right? So now we're using volume with demand and supply, right? So now we have no demand for higher prices because we literally see the word no demand. The rising prices and the waning volume has finally reached its end, and now the prices are falling, and this is the opposite of what you think to be normal. This is when, you know, they're actually buying, right? The prices are falling. They're actually buying, and again, that's why we call it supply coming in, supply coming in, whatever, because
Demand coming in at the bottom.
Well, there's no demand at the top, and then when you know you're done with the accumulation phase, that's when you start to see supply coming in, right? Because it kind of makes sense, because this is the opposite of what you normally think, right? Why would the prices rise if there's all this supply? So again, this is what I look for. Here's the start of the distribution phase. It's not really clear, not easy to trade it, but then I get a little bit narrower bars. They test, they come back down. I get ultra high volume all through here. The market starts to go. I get tests. That looks like a 2-bar reversal, 1, 2.
Yeah,
I think about a pair of tall boots for a woman. They fit in a long box, and they have the shaft and the foot is down one end, and then the opposite way on the other end. That's exactly what a 2-bar reversal looks like. It looks like a pair of boots in a shoebox, because you basically have a close on at the bottom, and then it reverses and it closes up or near the top. And so you have the 2-bar reversal. I drew a line at the close because I always want to, there's a reason why it closed there. If there's ultra high volume, widespread, there's a lot of activity. It's a reason why it closed there. So I always draw a line there because I expect it to retest, and there it is again. Now look, the volume is high, but it's not as high as that. So again, it's that effort. It can't break through. So it bounces back up, goes back into this area, and then you start to see, you know, a little bit of a sign of weakness. So again, it's that U. And so as demand wanes and the prices fall, and then you're looking for that U for then the new distribution phase of supplies coming in. So here we have, a daily chart. You're in an overall uptrend on the far right of the chart, but let's go back. This is the exact same chart I just showed you. I just cut it down a size so you could just focus on the part I wanted you to focus on. Here in the background we had rising prices, distribution, kind of didn't really have any interest, volume goes down. We start to get massive volume here. We get this 2-bar reversal. I always draw a line, like I said. It goes up, it kind of goes back into this area, and it fails. One thing that I will point out is sometimes people get confused when they see signs of weakness in an accumulation period. I love it because if an upthrust fails, then I can absolutely expect for the market to go back down again. Because basically, a failed upthrust is the same as like a confirmed test, right? It's retesting this area and it's not working. The volume's lower. It's coming back in here and going, anyone? Bueller? Nope, no one's there. Goes back down. It's not magic that it's retesting back in this area where we saw the ultra high volume, because that's the source of the maneuver. That's the start of it. We go back up and we come back into here, and then again you see signs of weakness, but the bar closes a little higher, and then this bar closes right on the dead low, right? It goes all the way up, tries to reach that, and tries to break this bar, closes. We come down into this area. We come back up, we come down, we come up, and we come all the way back here, and we're right back here. So now we have a double bottom. Come back up here, not clear, we go through, come back down, now we have A, B, and C. There's a reason why they're in sort of one's higher than the next. This is now the third higher low, so it's the testing ground. It goes back up into this area. Now we have 3 tops again, and it goes down again one more time. It never comes back down here. It goes here, and it just goes. One thing I want to point out, you don't see a test in this area. Unfortunately, the trend right here is obscuring it, but what you do see is a failed no demand. So this is a little secret I'm going to share with you. A failed no demand is the same as a successful test. Just like if you see a failed test at the top of the market, it's the same as a successful no demand. They are the inverse relationship of each other. So what this is basically a test. It's a failed no demand. So it's like, yep, roger that. So away you go. And if you missed this, that's okay. Come back up here. If it breaks through one of these tops, great, move your way up. You start to see things. Look at this. The volume never reaches anywhere back up into this area. That's why the background is so important. And that's why I think the daily chart can kind of help you give you overall trends, even when you're trading within that small time frame.
Also, you might want to mention, with no demands, it needs confirmation from the next bar to close lower. So if you get no demands in an uptrend and they're not being confirmed, you will get red signals.
So, in other words, Gavin said it, very similar to what I was saying. If you are getting a no demand in an uptrend, and then the next bar, is failing, that's what I'm saying. You're not getting that confirmation, right? So a failed no demand confirmation is the same as a successful test. It's basically confirming that you're in an uptrend. It's helped me considerably when I'm in a trade, because you get a little nervous when you're in a trade, right? It's human nature. And you start to see a no demand, and we know the significance of no demands, right? But if it fails, you're like, all right, no, I'm good. So that's why those are really good confirmation signals. Same thing if you're in a downtrend and, you get a failed test. I've actually seen in situations during the mushroom over period where I don't get a no demand. Instead, by the time the supply comes in on the left side, it goes up, it does its thing, and it starts to come back down. I haven't seen a no demand. Instead, I got a failed test. And it's the same thing. It just drops out from under you. So, they have a very special inverse relationship with each other. So failed confirmation of the opposite is confirmation. These are very powerful signals. These will get you out of a really bad trade. They will help you enter a trade, and they are, leading indicators. That's why they're called confirmation signals, because they're typically part of the 3-signal sequence. I didn't have the smart scanner or anything like that 5 years ago when I was learning this. So I focused most of my energy on on testing and no demand. Upthrusts, testing, and no demand. I focused most of my energy on that because I really wanted to understand the why. Why is prices changing? And so no demand and tests are the 3rd signal typically in a full sequence, and it'll help you enter a trade and then it'll help you exit a trade.
You might want to explain what sequence is, because some people might...
I'm getting to that. So Gavin just said, what do you mean by sequence? So hold on one moment and I'll tell you. Thank you. Excellent segue. So again, here we have, on the left side, we have ultra high volume. We have a little bit, I don't know if this is a true bar reversal, I can't tell from right here. It goes down a little bit lower. And I'm interested in the fact that, a signal doesn't appear. So I think to myself, well, you know what? I should really draw a line. So if you draw a line from left to right, the volume is high over here. The next time that it comes back in to test it, it breaks through this. The volume isn't that high, and it closes right at the top. So that means there's really no interest to the downside. They were trying. There's a lot of energy there, but it always goes back. That's why the background is so important. You come up through here. Look at this. You come up here. You're back into this area. You come up, and you come down. So here's a failed test right here. You start to go up, but you're in this like chop. It's not clear. No surprise here. I'm in the E-mini and a 3-minute chart. So that's why I don't typically trade on the 3-minute. I use it as a confirmation signal. But we basically have this range. We've established a range, a bottom, and then it starts to come up. It comes back into this area. It comes back down, but not as low as that. The volume just can't sustain it. So this tells me long term that we're in an uptrend. And on the far right of the screen, we just moved the little webinar thing. On the far right of the screen, wouldn't you know it, we end up with supply coming in, and we end up with ultra high volume relative to the last 20 bars. All right, here is another chart. Let me show you this. Look at bar A. We have trending, 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 right, comes down. We have this ultra high volume, widespread bar, down bar, and I'm paying attention to it. So I draw a line across the closing price because I really want to know, is it going to retest in that area? Am I going to get a no demand? Am I getting an up thrust right in that area before it falls again? Starts to fall again, and all of a sudden I end up with a very widespread bar again, and then I get this weird bar, and it's tested exactly back into this area. My signal appears. I have much higher volume over these two bars. I draw another line. You're going to see it constantly try and come up, come down. It comes down again. It comes back up in this area. Hello, anyone there? No, comes back down again. And then it starts to push up. At the moment that it pushes through A, I would expect to see supply coming in. And that's what I mean by the U. Just remember, it's not always a full U. Bag holding and a trap up move are usually the topmost tops and the bottommost bottoms. That's when you see a real exaggerated U or mushroom. But for the most part, if you pay attention to the ultra high volume and you pay attention to the start of the maneuvers, mark the close. That's why these closes are so important. I like what Gary said, where he said, I want obvious support and resistance lines. I do too. And I figured it out because it's the close. That's why VSA works.
I call them trigger numbers, don't I, in the book? And they trigger the trade once the market shows you that it's changed behaviour.
So Gavin's right. He calls them trigger numbers. These are the closes of these bars that keep getting retested, and it'll indicate to you when it's time to take a trade. So putting the analysis into action, I remember when I first started, people would accuse me of being theoretical. Yeah, but do you trade? Well, hell yeah, I trade. So ultra high volume, remember, it's going to mark the start of the selling or buying. Widespread bars are going to show you the amount of selling or buying depending on which phase you're in. And the closing price is going to indicate interest level. I don't think people pay enough attention to the closing price. Most people can spot the skyscraper volume bar pretty easily. Oh yeah, I see that, okay. Yep, I see a widespread bar. Okay, yep, I know it's the start of the maneuver. But how do you get out of the trade? How do you know when to enter the trade? Go back to the closing price. It's going to tell you. That's why I always draw a line. And then whether it's an exaggerated or a smaller mushroom, like this is a more exaggerated, beautiful mushroom. But if you draw a line, oops, sorry. If you draw a line from here to here, this is where you can see it play out, and it's going to retest those areas. And so this is where I wanted to show the VSA signals indicate a sequence setup. You need at least 3 signals to really make it a sequence. You may get more. So if you're thinking about signs of weakness trade setups, again, throughout this period, you're going to start to see supply coming in. That's usually number 1. It's going to start, remember, it's going to start to go up. The volume's going to go down, and you're going to see an up thrust. So this is my favorite setup. I trade this all the time. And then number 3 over here, back into this area of number 1, I see a no demand. But you always get to ask what's behind you, right? What am I seeing behind? And then, right after 3 gets confirmed is when you can take a short. This trade setup is also an excellent exit strategy if you're long, like we were saying before. The prices rise, sometimes I'll end up somewhere above number 1, I'll get in, I'll watch this, and I'll move my line up, and as it starts to mushroom over, I'll just catch a nice little wave there. Again, I'm not greedy, I'm grateful. You can't see that at all. Okay, just imagine there's a U there. So we have signs of strength trade setups, right? So on the one hand, again, you see stopping volume. You might see shakeout. Shakeout actually might be somewhere around, somewhere between 1 and 2. And the reason why I say that is because number 1, you'll see stopping volume, ultra high volume, widespread bars. That'll be bar A. You start to see it. You're at the end of the distribution. You've finished your mushroom. You're starting to come down. But the reason why I put both is because sometimes you can see stopping volume, and then you can see a shakeout or a 2-bar reversal. And the tests in an accumulation phase are there all along the way for you. And I always see a combination of test and no supply. No supply, confirmed. Test, confirmed. And number 2 and number 3, again, it's not always a perfect U. You're going to see number 2 and 3 throughout. That's why I never mind if we saw one that was in an overall uptrend. go in if you see a confirmed test. Go in if you see a confirmed no supply. You might be able to catch that nice little wave on the way up and pocket some profit. But again, always ask what's behind you, because until it starts to come back up again, you don't want to go long. So again, we have this behind us in the background, ultra high volume. It kind of reversed itself here. It goes up, and then it comes back down here. And this is where, it's starting. And this is the highest volume we've had, relative speaking. We come down and we come back up. So you draw a line across here, and then you start to come. It's still choppy. I wouldn't trade it yet. But then over here on the far right of the chart, that's where you go long. I learned distribution first because it seemed more obvious to me. Personally speaking, I find the accumulation phase a bit confusing. And the reason why it does take longer. And the reason why is, number one, I start to see something like stopping volume, right? But tests and no supplies can happen at any point during that U, at any point during that accumulation phase. But if I keep seeing them and they're confirmed, I'm pretty happy. Did that answer your question?
Well, if let's say you put no supply S2 and test them for S3.
Oh, yes, okay, yes. So the question was, can you reverse test a no supply? And the answer is yes.
Exactly.
It is the same thing. You could even, like I said, you could substitute no supply for a failed no demand, right? So they have that beautiful inverse relationship. And the reason why I have stopping volume or shakeout as number one is because sometimes you see stopping volume and then immediately you'll see a shakeout or you'll see a 2-bar reversal, and it's still before a test or a no supply.
No, let me just quickly say something. One of the things that Wyckoff taught us, sorry, just quickly.
Yeah.
One of the things Wyckoff taught us was that he talked about Gary 9 tests, I think it was, that Hank Pruden teaches as well. So Tom, when he was teaching me, he said, well, we don't need to go all around the houses with this. He said, a test is a test. But then, interestingly enough, I said to him, Tom, no supply is a test, right? Yeah. I said, why didn't you just call everything a test in the software and in your book? He said, well, it's like a leaf on a tree, Gavin. If you look at 2 leaves, or you look at an oak tree and you put 2 leaves together, they look almost identical. But once you put them under the microscope and examine them, you're going to see slight differences. He said, in my computer coding, there's slight differences in each piece of code for each test or no supply, which we don't tell everybody that, but it's exactly the truth. So you've actually got in the software somewhere in the region of 30 tests and about 25 no supply. Mm-hmm. But they're doing the same thing. What no supply means, it's a down bar, it's always down bar on no supply. It's a down bar on volume less than the previous 2 bars, narrow spread, and the next bar confirms. Mm-hmm. Does that answer the question? So the testing, you see it all over the place. The best place to trade a test is after the shakeout, which you've discussed, after the climactic bar, the market begins to move up. I do what you do. I draw the line across the top of the high volume bar, pushes through there, first test, I'm in. It's exactly what happened with that Australian dollar trade. And it went to the tick and came straight back off again.
And then when you're in the trade, the tests help you as well. My favorite trade setup is supply coming in, up thrust, no demand. I'll trade that all day long. My next favorite trade setup is after this has all happened on this slide, after the U has broken through, and then I see like a second or third test and I'm in an overall uptrend. I enjoy that one because I feel like the market falls a lot easier than it rises, so I feel like I see the fall, the distribution more often. I would be happy trading all day long based on the distribution cycle both ways. So supply coming in, up thrust, no demand, short. But I see a supply coming in after I've seen a successful accumulation U, go long. Love it. And I'll get out right after the up thrust. So those have been very good to me. Occasionally I'll do an absorption volume trade. It doesn't happen that often. When it does, it's just beautiful. But it doesn't happen that often. You have to be patient for it, and you need multiple confirmations. And what I find is I'm less successful percentage-wise because the absorption volume, for those of you that don't know, it closes at the absolute top. It could be the start of distribution. It's a very widespread bar, but you absolutely need confirmation 2 bars later. And sometimes when you think you have the confirmation, they'll go back down and you'll get stopped out. So that's one of the hardest things about absorption volume to trade it. You get stopped out a lot. The setup is right. You're on something, but you get stopped out a lot.
They whipsaw the market a lot.
They do. Whenever I see absorption volume, I get excited, and then I'm like, right, remember, statistically speaking, you have not done well on this trade line. So perhaps you should wait.
And the other thing about absorption, you want to mention this, it usually takes out an old top to the left where it's been resistance, and it's the energy and the volume, and it will have a red signal on it all the time.
Yes.
Test it, it's going to go again.
So thank you, Gavin. You're right. So one of the other things about absorption volume is not only can it be the start of a distribution phase, again, widespread bar, ultra high volume closes right at the top, like not a little bit before, right at the top. So it looks like a backwards L. It always takes out an old top behind you. And that's why when you see these climactic action bars, you got to mark the close. Look behind you, go to a wider time frame, see what it's been doing before. Numbers return from whence they came, the trigger number. You see it all the time. And then you wait for confirmation, but that's where you can really see a good distribution because there's so much energy and so much effort to break through that top. Actually, one of my best trades that I took was the yen dollar. I saw absorption volume. I checked a bunch of time frames. I couldn't believe I was seeing it. It had broken through this old top, and I waited, and the volume was still strong enough, and I went long, and it just kept going. It just kept going. And, of course, I was a very new trader at the time, so I just was so happy to take my, $347 or whatever it was, but I could have made a lot more money if I'd actually stuck with it and just slowly went up. I mean, it just was like elementary. It broke through what it had been doing after it had been fighting, trying to fight, and it broke through, and I waited again, and the volume didn't wane, and it broke through. It was gorgeous. So I guess one thing I'll say to you is you don't need to trade at the beginning and the end of a smart money maneuver. You should recognize it and be grateful if you can take just a little of it, get a little slice, get a little of the action. I don't think that VSA is difficult to understand. I think that, again, like I was saying to you before, it's counterintuitive. It's like driving into a skid versus braking. It's counterintuitive. It wasn't until I had a trading plan and I had what I will do and what I won't do. I won't trade on, a news day. I won't trade during typical holidays. I won't trade during the U.S. Open. I'm not going to get caught in that. I've gotten caught in that, and I don't want to get chewed up and spit out. And I wait for my setups. And I'd never heard the term Gary rotational day. I don't like them. I don't like them at all. I like my trend days. I like to go in when I see it and go out when I see it. But, it's any chart, any time frame, any day, you can see these sequence setups built. So if you see the setup, it's good. I think that's one of the other things that I'm excited about. I haven't installed the Smart Center Pro yet.
That name right either.
Sorry, the Smart Center Pro, the trade setups. But I love that idea because if you see a setup in a rotational day like that, I think that's more confirmation.